Hi, this episode is all about options moneyness. Moneyness is a core part of our language as options traders, and knowing and understanding it is crucial. Without that, you will always be struggling to understand what other traders and experts are trying to say.
Now, as option traders, we categorize our options into three distinct categories. So, in the money, at the money, and out of the money. Now, these labels allow us as traders to quickly reference different options while we create these advanced strategies. Now, as you'll find in this course and in our other strategy guides and throughout our video tutorials here at the Income Option, we often discuss purchasing an in the money option and selling an out of the money option, or vice versa, and combinations of various such options. So when we look at terminology, it's very important to understand in the money, at the money, and out of the money options, because going forward we will be using these extensively to describe and define our strategies. So when we are as options trader, we'll quickly take this into our vocabulary and then apply it when we are creating those advanced strategies. And as I mentioned, these are also used to build those advanced strategies. So such terms are very handy for us as traders, as a group, to look at these positions based on the moneyness and the moneyness in the options pricing table. Okay, so I'm going to illustrate this with a simple call options diagram to make you understand what exactly moneyness is, and we'll look at subsequently. We'll also look at a put option as well. So that will give you an overall view of what options will look like in the moneyness. So the moneyness of a call option varies obviously with the stock price. So that's what we've seen. Now let's look at how that works out. So for the call option and in the money call option is when the price is greater than the strike price. Okay, so let's look at this call option that we have on the left, the payoff diagram, and as you can tell, the strike price of this option is 40 rupees, right? And you can tell that by this pivot point that we have in the payoff diagram or in the payoff line. Now, when the price is somewhere above 40, so let's say the price is currently at 50, when the price is higher than the strike price, that's when the option is considered to be in the money, right? And at the money is when the current market price is somewhere around the strike price. So if it is moving around 40 rupees a rupee here or there, that's when the price is when the option is considered to be an at the money call option. And likewise, when the price is lower than the strike price, so when the price is somewhere around 30 rupees, let's say, then this call option will be considered out of the money. Now, I always look at or I simplify moneyness by being profitable, right? So when I've bought a call option, there are simple call options. I've bought a call option, and in my trading platform, when I see it mark to market in green, then I say that this option is in the money. When it is around the zero profitability level, then I would consider that at the money. And if it is in the negative, it's showing me in red, then I would consider it at out of the money. And as we will see in the pricing chart, it becomes a lot easier to understand it. But very simply, moneyness can be equated to profitability. Obviously, this is a simplified version. There are the extrinsic value that we will be looking at, which may differ this definition in a sense, right? And we will look at that extrinsic value in a bit as well. So now let's switch gears a little bit and look at put options. These operate inversely to call options. So an in the money put option will have the price less than the strike price, and at the money would have a price equal to, as always, and an out of the money will have the price greater than the strike price, right? So if you take a put option with a strike price of 40 rupees, then an in the money put option will be when the strike price is, say, somewhere around 30, which is basically more than 40 rupees, right? So that would be an in the money. Why is it in the money? Because as you know, put options give us the right as buyers to sell the underlying asset at the predetermined price, which is the strike price. So at this point it is 40 rupees. So if the market is currently at 30 rupees, then I can effectively buy in the market at 30 rupees and sell it to my seller of the options contract at 40 rupees. And if it is higher, which is that it is out of the money, say somewhere around 50 rupees, then that will not allow me to do that. There will be no value in the no intrinsic value in the options, in the put option, and therefore I will be tending to make a loss, which is the premium that I have paid. Now, as you can see in the chart, I just want to point out that this chart or this line, the yellow line, crosses the 0 point somewhere over here. That's because as we saw earlier, that's because of the premium that I have paid. So I need to make back that premium before I become profitable. So although you may not be profitable because of the premium that you've paid, you may still be in the money. That it depends on the amount of money that you have paid in terms of premium. Okay, so just wanted to point that out, and works likewise in the call option as well. So which basically brings me to the intrinsic value and the extrinsic value, the time value of which form options premium. So as I said, the option pricing, the option premium comprises of two components, the intrinsic and extrinsic value. The intrinsic value denotes the option's profitability at expiration, right? So remember that this is at expiration. This is what we're considering. So it depends entirely, the moneyness will depend entirely on what the situation is at expiration. So if it has value, if it's in the money, then it will be profitable. Otherwise, it's out of the money. It will be, you'll be making loss as far as the intrinsic value is concerned. So typically, at the money options hover slightly in or out of the money. So depending on where it finally closes at expiration, you may or may not make a profitable, or you'll be just about breaking even. Now remember, the time value is denoted by the amount of time that is left, but it is comprised of not just the time value. It is the time is representative of the potential dividends, potential the interest component, and of course the volatility in the underlying asset. So for example, if I hold a call option for a year-long expiration, then there is the potential of receiving dividend. There is the potential of having to pay or having the profit from the interest component as well. So that is all included in the time value. So now we will use the example of JSW Steel, and we'll jump into the platform that is the Defined Securities platform, the option strategy, the Opstra platform, and I will show you what it looks like, what Moneyness looks like in the platform with the option chain, right? And you will see how the intrinsic value represents immediate profit, and while the extrinsic value is driven by things like, as I said, time decay, volatility, dividends, and interest rates, right? And as I said, as we explore option strategies going forward, this becomes very important. It becomes part of a vocabulary. So it's very important to understand what in the money, at the money, and out of the money indicate, and sort of absorb it, ingrain it into our vocabulary. Okay, so here we are in the options, the finite securities platform for option strategies called Opstra. And very quickly we're going to go into the builder area, which is where we will see the options chain as well. So but before that, obviously we need to define the stock. By default it comes to Nifty, but we're going to go ahead and look for the stock that we want to look at. And just as by way of an example, we'll go ahead and look for JSW Steel. Why JSW Steel? No particular reason, but we're going to go ahead and look at JSW Steel. So this is the options chain, and you can select either near strike or all strikes, and you can also select, as we saw earlier, the expiry dates as well. So what you will see are the immediate expiry dates or the available expiry dates for this option, and in this case there is only the three near strikes, near expiry that are there of September, October, and November. Now remember, the JSW Steel, unlike the Nifty stock, Nifty options have only monthly expiry. And in this platform, and other platforms may differ, but in this platform you'll have the current market price or the strike corresponding to the current market price, colored green right in the middle, this green band that you see in the middle. As you can see, the price of the spot price of JSW Steel is 809.4. So 810 is the closest strike price to the current market price. And likewise, this is colored in that green band that you see. Now what you will see is that the calls are on the left and the puts are on the right. Now the last traded price is what you see in the middle right over here, which is colored in blue, right? And for the put options in this orange font that you see on the right side. So you have call on the left and puts on the right. Now as we saw, as the call price, as the strike price increases, the call goes into the strike price with a lower the calls with a lower strike price go in the money. The calls with the strike price equal to the current market price are at the money, and of course the calls with the strike price are higher than the current market price are out of the money. So what we saw in the previous slide, all these calls, the ones that are above the current market price in this platform, of course, or are lower than the current market price, are all in the money. So accordingly you'll see that the price of these calls increase as it goes higher. Now you'll notice that it doesn't increase in step with the strike price. That's because we saw that intrinsic value as well as extrinsic value. And likewise, when it goes away, that is above the strike price, you will see that the value of the calls also start decreasing. That's because there is no intrinsic value for the calls that are out of the money. At the money calls will be pretty much in step with the strike price, with the movement in strike price, not in terms of 1:1 per rupee movement, but overall there will be a more of a correlationship between those prices. Likewise, on the put side, we have as the price decreases, that is the current market price or the strikes decrease, we have the price of the put option becoming cheaper, and as the price increases, the price of the put option also increases. That's because the lower strike price means that you can now have it. The lower price means that you can actually buy it at a lower price and then sell it at a higher price because you already have that contract in place. All right. So hopefully this gives you a more real world example of what we just discussed in terms of options moneyness. Once again, thank you for watching. This has been helpful in helping you understand options moneyness. And if you like this video, please do share it. If you have any feedback, please leave it in the comments section below. And I look forward to seeing you in the next video. Thank you.